tracking of implied volatility rank trade dynamics.
Yeah, so we're getting a little bit more creative with the titles, obviously.
Well, we used to be creative with the titles, but then they said that people could not search them and find what they wanted. So we had to lose some of the creativity to help people that were searching through our archives.
I remember that.
IVR trade dynamics. I'm going to let you take the lead on this, okay?
Okay. All right. So you are color man, and I'm
the color guy. Yes.
There we go. All right. So what we're going to kind of look at here is we have IV rank. We know what it is, how much implied volatility is elevated or depressed. Right now, it's more on the depressed side as a lot of the IV has gotten sucked out of the markets. So in the realm of trading, the practice involves skillfully navigating trades within different implied volatility environments. So IV rank, we call below 30, we call that low. Above 30, we call that high. Crucial metric in options trading that gauges market expectations for future price changes. A little colorful language here. Or not colorful. A lot of different vocabulary. There we go. Yeah, and that's funny enough. You're gonna see a word in this segment, Tom, that I'm gonna ask.
Hey! Listen, I'm the color guy. Okay?
I know.
You're the play-by-play guy. The play-by-play guy is the straight guy.
All right. Listen, I'm the play-by-play, right? So let's just take it how I do it. All right. When approaching trade choices, it is vital to take into consideration both the opportunities for maximizing profit and areas where risk can be minimized, right? So that's the whole name of the game. IV rank helps us do that. So now we're going to look at if we have strangles, if we have different trades, how does the IV rank environments influence or change the metrics of our trades? We've done this a lot of different ways in the past. I think it's a good way to refresh it, especially after we've gone through 2021, 2022, or halfway through 2023. So let's see what happens if any of the stats change or if they all stay as expected. So let's go to the next slide. SPY, we're going to take a look at selling 16 Delta strangles. This is up to date as of just this week, actually. So fresh options data. We're going to manage it 21 days. We're going to compute the average daily P&L, the win rate, and the risk. That's the main metrics we care about as traders, and the risk will be computed as CVAR, which is the worst 5% of losses. That's what we consider risk when we trade options. And we're going to compare all these in high and low IV rank environments. The cutoff will be 30 for that. So, all right, let's go to the next slide. By taking a look at the table below, it shows that selling a trade in high IV rank environments is managed in 21 days. The average daily P&L will tend to increase by 23% compared to selling in low IVR. So, and this is kind of like and maybe the actual P&L, but the daily P&L is actually significantly higher than that. So the success rate will almost be the same. So this has been the story, right, since the creation of Tasty, right? We show that if we sell when the IV is high, IV rank is high, the win rate doesn't change. They stays very, very similar, but the difference is the P&L. The P&L increases by almost $1 on these, depending on if you sell when it's low and when it's high. The key is to know that if you sell when IV rank is low, you sell premium, it's not negative. You still get a positive P&L. The difference is it's a lot lower, and you can't allocate as much capital because you have more risk in that case. So that's why we say stay small, but not don't trade, right? That's two different things.
I think that this is one of the hardest concepts to grasp when you're first starting out with a very strategic approach to trading. One of the biggest challenges that that I really feel like everybody faces, specifically in high IV, there's nothing you have to explain. But in low IV, it is difficult to understand that the win rate essentially stays the same, whether it's individual stocks, whether it's indexes, whatever it is. The win rate's never going to change because the win rate is just a math equation.
Right.
The difference is that the amount of money that you can make for the risk that you're taking is dramatically different. And because of that, that's what we talk about mechanics. Like that's the whole thing with trade mechanics is if you're going to take a certain amount of risk to do things, then you want to get rewarded for the risk. And in one situation, Like if you get rewarded, let's say in one situation you can make $1, in another situation take the same amount of risk, you can only make 25 cents, but the losses in both cases are virtually the same, then that's the whole game of pot odds. That's the whole game of, tasty mechanics. And I think that's the part we need people to grasp.
Right. And I want to also, again, reiterate the fact that nothing is a quote unquote bad trade, right? If you sell premium when IV rank is low, I mean, we just did it a few times on the fast market, right? It's not a bad trade inherently. You're just not going to make as much, right? And that's the whole thing. Mainly making your portfolio structured that you're not going to make as much, but that's okay because you're going to stay small. So when IV goes back up, you can put more capital and you can make more, and that makes up for all the times that IV is low. All right, let's go to the next slide. We're going to talk about the risk here. This table shows that the risk of selling in low IV, selling premium in low IV, is greater than selling premium in high IVR. This is also counterintuitive to a lot of people. This indicates that the trade's vulnerability to adverse price movements is greater when the market anticipates minimal price swings. It's a very good way of, it's actually a very good way of saying this, because it's just like we were talking about earlier in the morning in the SPX butterflies. IV rank is low, or IV is low. It's hard to make money on those butterflies because even a 20-point move in the S&Ps will make that butterfly a loss, right? Versus a few months ago when you could have a 40-point move in the S&P and the butterfly was still a winner, right? In such circumstances, even minor price changes can disproportionately affect the trade's overall profitability. The interesting thing is when IV rank is low, your risk or your CVAR, the worst 5% of losses, is actually higher than when IV rank is high. And it's counterintuitive because you think, well, wait a second, IV is high. Markets are moving a lot. Why is my risk lower? Well, it's because the market has to move even more than it has already been moving to make a loss. Anything below that means you're winning.
It's very counterintuitive, and I think it's even on a professional level, I just don't think people get this, and we're not even talking about well, let's put it this way, it's very counterintuitive. I'll just leave it there because I don't want to confuse people, but the fact that you take less risk when the perception of risk is greater is, to me, one of the fascinating things about strategic trading.
So, it's interesting. I was talking to Nick and Mike about this, and there's a really good analogy when you play poker, right, Tom? Because you've played poker. I know you hate the game, but you've played it, so you kind of know how to think about this. So let's say you have a pot and there are only one caller besides you, right? No matter how good your hand is, right, your pop can be very high, your strategy can be good, but you can only make up to that person's amount, right, or that they have behind them. That's like IV being low, right? You can have a good hand, everything can go well, but you're still limited to the amount you can make. When IV rank is high, it's like having 9 callers and you have pocket aces, right? Of course, the chance that somebody could hit something and win, sure, it's a little bit higher, but you have 9 more callers in the middle. So your odds are 9-1, regardless what your hand is. And that's kind of the same thing to think of it. It's like, it doesn't matter what the market necessarily does, as long as it doesn't explode.
You're exactly right. So that's a good example.
So let's go to the next slide. Conversely, when implied volatility is elevated and the market anticipates substantial price swings, the inherent risk associated with the trade may be subdued. This is because the trade stands to benefit from larger and potentially compensatory price movements. This is the word I was one of our researchers, Gad, he did this piece, and I was like, Gad, how often do you use the word compensatory in your day-to-day language? And he's like, I'm like, all right, I like it. But this is very true, right? When you have such large price swings, the market anticipates that. So unless there are even larger price swings tomorrow, IV is going to go down, and that's why the risk is smaller.
Yeah, I mean, essentially, the high implied volatility eliminates a lot of the outlier risk, and that's the outlier risk is what pushes the averages. Is the outlier risk in low implied volatility is what pushes the averages down so much. So by removing the outlier risk in high implied volatility, it just makes the numbers look so much better. And then, of course, by managing early is the other piece to it. But sure, let's go on.
All right. Let's take a look at the last slide. So in terms of volatility, our research reveals that selling a trade managed over a 21-day period tends to offer greater advantages in high IV rank environments compared to low IV rank environments. This indicates that in high IV rank environments, the average P&L can increase by 23%, in some cases even more, and the risk reduces by 84%, again, depending on which metrics you're looking at. In this case, we looked at CVAR, P&L, on a daily basis, but you can also look at just the raw trade P&L. You can look at standard deviation of P&L. You can look at a lot of different things. So no matter how you cut it, risk is reduced, P&L increases compared to selling in low IV rank environments. And however, due to having relatively similar success rate in both environments, remember to also factor in the trading strategy, position size, and market conditions. And I think that's very true. Keep in mind that success rate will stay relatively the same because that's always based off the delta, but the actual profitability and risk metrics will be favorable.
There's a lot of stuff in here, but trust me that over time you can this will all run through your head in literally in milliseconds, and it happens way faster. The more times you do it, it happens just way faster in your head, and you know exactly what strike to go to. So it's repetition and longevity.
Yep. Exactly.
All right. Good stuff, Mr. Anton. We are going to take a short break. We're going to come back with Scott Sheridan, who is going to jump on from the Tasty Trade headquarters. And then, Anton, you're going to hang on with us, right?
Absolutely.
Beautiful.